Hey guys, welcome back to another real estate bubble video. 4 months ago, we put out a video asking whether the bubble will pop with the looming interest rate hikes to fight the sky-high inflation levels that we're seeing. We did put out a warning that it's very possible that property prices could level off or even go downward this year. So now we're asking, has the real estate bubble finally popped, or has it simply deflated a bit temporarily? Let's delve into this and see if we can get some answers.
So far in the report, we're seeing a decline in the number of home sales and prices trending downwards.
The real estate market continues to cool down in Toronto.
We've seen now data in both Canada and the US that despite the central bank increasing interest rates, inflation continues to grow.
Tiff Macklem, the head of the Bank of Canada, said they have no choice. I mean, inflation is such a big deal right now that they have to act aggressively.
The Bank of Canada is raising the interest rate by 100 basis points, the highest hike since 1998, up to 2.5%.
Welcome back. I'm Andy from Sweet Additions, where we help homeowners and investors build better homes while creating lasting wealth with legal additional suites. Download our free guides at www.sweetadditions.com to get started. And please do us a huge favor by giving us a thumbs up on this video and subscribing to this channel so that we can get more content out. Okay, so as of June of this year, average GTA real estate has gone down from its February peak by about 16%, or roughly 189,000. That's a big drop. Inflation has been persistent and in Canada has surpassed 7%. In response, the Central Bank of Canada has raised rates overall to 2.5%, which is 2% higher since the last time we did a video of this in March, where the overnight lending rate was 0.5%. The last rate increase on July 13th was a whopping 1%, which is the single biggest rate hike in 24 years. Wow, quite honestly, I did not think that they would do this in a single day. Well, here we are with rates at 2.5% and what seems like a firm commitment from the Bank of Canada to continue to raise rates to 3.5% by the end of the year, or even higher, to bring down inflation. So with all of this action, it appears that the real estate bubble has been pricked. Now the question is, has the real estate bubble popped and is now the beginning of the massive crash that many people are saying is long overdue, possibly crashing over 50%? Or is this simply a bubble that has deflated temporarily before the next run-up? Let's try to get some answers. Surely with persistent inflation, additional hikes coming up, and a looming recession, we can expect further price declines in houses, right? And we should definitely not go anywhere near real estate right now. Would you agree? This may be the case. Most people you ask seem to agree that now is definitely not the time to buy houses. Even Oxford Economics suggests a 24% price drop by 2024. Let's dig a bit deeper into the macro landscape to try to get a clearer picture. Central banks across the Western world, including Canada and US, are intent on fighting inflation with everything they got. In Canada, inflation is well over 7%, and in the US, it's over 9%. And their target is to have inflation at just 2%. It seems the single tool they have in their toolbox to try and fight this inflation is to increase interest rates, and they are intent on doing so. So let's play this out and see what it means. Before we do that, I'd like to point out one important factor. Now, when they talk about increasing rates to slow down inflation, a lot of attention is paid to over-indebted and over-leveraged individuals, households, and businesses, basically the private sector. And not enough attention is placed to the over-indebted and over-leveraged government. Currently, the Canadian public debt levels are sitting at almost $1.2 trillion, 14 times what it was 40 years ago in 1982. Looking at the US, where, let's face it, we in Canada follow in terms of our monetary policy, their debt levels are $30.5 trillion. If rates were to get to 3.5%, in Canada, the interest payments alone on the debt would be $42 billion a year. In the US, 3.5% would mean $1 trillion a year just in interest payments alone. This surpasses their entire military spending. And trust me, they spend a lot of money on the military.
Roger that.
Keep in mind, the US also has unfunded liabilities of $107 trillion owed to their own citizens for things like Social Security, Medicare, and other liabilities. The numbers are so staggering, it's hard to wrap your heads around it. In Canada, we also have a lot of unfunded liabilities ourselves in the trillions. Okay, what does this all mean? Well, when the central banks raise interest rates, it's a double whammy for the government.
I told you to stay away.
Interest payments on public debt increases, which is the first whammy. At the same time as a slowing economy where businesses don't make money or even close down, meaning less tax revenue from the private sector. This is the second whammy.
Stop! Oh my gosh! Oh my gosh!
I've come to take all your cash.
What's going on?
What? You don't have any money? Well, this is awkward.
Remember, the government doesn't have any money. There's only three ways for them to get more money. It's either tax it, which is going to be limited in a slowing economy. They can borrow it, which is increasingly harder these days. The last option is to print the money, which is probably what they're going to have to do to cover the shortfall. Again, I'm talking about the US a lot, but understand wherever the US is headed, we here in Canada are going in the same direction. Now, if let's say the central banks pivot and decides to loosen credit again, it means they will essentially print more money, buy bonds from the government, and lend them the money. What this essentially means is that eventually all roads lead to more money printing. My guess would be that the economy at some point in the next year would be in such bad shape that the government may increase their inflation targets to a much higher than 2% level. And what do you want to own as this happens? Essentially hard assets that can't be printed out of thin air, and I would include real estate as one of those assets. The amazing thing is that we can also force appreciation on houses as well by improving them physically. So having said all this, when people tell me that real estate is crashing and will probably drop by 50%, it means the banks are going to be holding a big liability if there's no collateral to roll over that debt. And do you think the government will let the big banks fail? I doubt it. If that happens, it would be a currency default and likely years or even decades of depression. But who knows? Anything can happen. Outside of macroeconomics, here in Canada, there are also external factors that are putting extra demand on housing. We have 400,000 new residents a year, with a third moving into Ontario. We need to double our housing construction to build the 1.5 million new homes necessary for our population. And this is all happening at the same time as the skilled labor force in construction is shrinking and Canada having the lowest rate of construction per capita out of the G7 countries. So the big question is now the time to jump into real estate? I'm still not so sure. In the short term and medium term, there could still be a lot of pain to come in the real estate market as rates continue to rise and some sellers may be forced to sell at a lower price, putting more downward pressure. Now, timing real estate is going to be very tricky. At the current time, inventory and sales activity is still low, and that could be because it's summer and the fall might bring out more inventory and activity. I'm personally looking at the moment specifically on property that I can force value appreciation to. Now, with the knowledge that I don't have to compete with 15 other offers and can actually put in purchase conditions again. Okay, now understand that none of this is intended to be investment advice, but rather my own observation and opinions, and I could be entirely wrong here. Please do your own due diligence and determine what works best for your unique situation. What I will do now is outline 8 things that are within your direct control when it comes to property, irrespective of what the big picture government is doing. Let's go over that now. First, you can choose which city or town you want to invest in. There are municipalities that have great leadership, are more focused on growth with a diverse economy, and generally want to be competitive. Check out the Ontario Growth Plan at ontario.ca/growth planning. Second, within a city, you can determine where the pockets of growth are going to be by going to the city's website and browsing through their official plan documents and attending planning and council meetings online. Third, the type of property is something you certainly have control over. You can choose a property that will likely be more insulated from a severe economic downturn. I generally like investing in modest single-family homes, especially the ones built in the mid-20th century, post-war to about 1970. These homes are well-built, have great bones, and are generally in desirable neighborhoods. Fourth, is it a property where you can add forced appreciation to and not just rely solely on the market? Are you able to add rooms, additions, curb appeal, and cosmetic upgrades to get a higher selling price, rental rate, or a higher appraisal if you wish to refinance the property? Fifth, are there great cash flow options? Can you use the space efficiently to generate cash flow? Are you able to rent out individual parts of the property, either short-term or long-term? For those who are familiar with the house hacking strategy, primarily used by younger homeowners who are more flexible, house hacking and renting out individual rooms help to reduce or even eliminate housing expenses. Number 6, and this is the big one for me and what I strongly recommend everyone to do to their property if possible, and that is to add additional units. This can be done in the form of converting to a duplex, 3 units, or even more. And with Bill 108 in Ontario, many cities are allowing garden suites to be built in your yards as third units. This can significantly increase your cash flow and boost the value of your property as well. Item number 7, even though we talked a lot about not being able to time the overall market cycles and the economy, there's a lot of data out there showing that you can at least time the seasonal market. Data shows that prices generally peak in the spring and the fall, and prices are lower in the months of December and August. Number 8, now for the last point, understand that it's important to be a savvy negotiator and not overpay for a property. There are plenty of resources out there to learn to be a great negotiator. If you're able to get a lower than market value price, then you've also gained a bit of a buffer in case of a market downturn. Try to create a win-win situation with the seller. So those are 8 items that you can use when buying real estate to take back as much control as possible on your asset. Okay, so that's all I got for you today. What are your thoughts? Am I missing something? Am I entirely off here? Do you think the real estate market will continue to crash further from here, move back up, or are we somewhere in between? Please share your comments below and let me know what you think. Again, please do me a huge favor by liking this video and subscribe to this channel if you haven't done so already. Thank you so much for watching till the end. Keep creating better homes while generating wealth, and we'll see you in the next video. Thank you so much for watching our video. We have a brand new garden suite guide, how to add one to your property. You can download a copy right now for free if you go to www.suiteadditions.com. We cover a ton of stuff you need to know if you want to start building these to create more housing and wealth at the same time. There's also a list of resources that we've identified that you can use. Download your copy now for free at www.suiteadditions.com.